Ben, good to see you. Obviously, a lot of comparisons being drawn between 2008, the initial canaries in the coal mine that people missed, versus this. How would you compare them?
Hi, Rochelle. Thank you for having us. Yeah, I do think there are parallels here. It's interesting how the sequence of these events are similar as at that time. If you started off with some canaries that didn't matter to the markets, as in FTX, for example, last year, but then leading to some bigger events like the UK pension system or back then the Bear Stearns hedge funds, we're now leading up to a situation where we may have a Bear Stearns type of a situation at our hand, with Credit Suisse being really in trouble and appealing now to the Swiss central bank for help. So markets are on alert that as you get these events, but in between a run on regional banks, there's a stress building in the system that's going to come out and leads us to some sort of a climax. Hard to predict what that then exactly is, but that's, I think, what markets are doing psychologically, being so on edge.
So then how likely are we going to see some of the mergers that we saw we saw with the 2008 crisis? Are we likely to see some more action there, or perhaps some more private investment coming into the space?
I think that's quite likely, because typically when you have the stresses building in one part of the market and it starts to spread, then you're going to get like certain entities start to quickly look at an opportunity to say, hey, here's really a way for us to show confidence to markets, but also a way, as in the valuations are getting better and therefore doing a deal, or it's out of indeed driven by emergency, maybe even driven by emergency as in governments, trying to incentivize parties to come together to try to diffuse the situation. So will Credit Suisse, for example, be taken over by another bank here? That's all in the background here, but you can imagine that there's obviously negotiations going on how to resolve this, and that will be one way. Or you could see this show up in the regional banking space here in the United States, for example. Either way, I think it is something that's also similar to that 2007-8 period when you saw a company like Bank of America taking over Merrill Lynch and Countrywide.
So what about these unrealized losses then? How much of that is systemic then? Obviously, we're going to see a lot more scrutiny of that. But was that another red flag that should have been missed given the pace of interest rate hikes that we saw in the US?
It's incredible, actually, that these unrealized losses are now being such a focus, because it's actually an accounting measure that's been in the banking system for a long time. These are not like opaque losses. They are simple treasury bonds, but they're accounted for unrealized because of the specific accounting rules and regulations. And therefore, now it has a sudden focus because in the case of SVB, deposit withdrawals led them to the point of that they were facing a rating downgrade and they had to raise capital and used their treasury bond portfolio to raise that capital in addition to equity, but had to realize the loss, and that suddenly caused a confidence crisis. And so now people are looking at this larger unrealized loss in the entire banking system as a reason to not have confidence in the banks. So I think it's going to continue to put pressure on the financial sector, but we cannot expect them to do all that unwinding of those losses. If anything, the Federal Reserve's new lending facility that started on Sunday is actually designed to avoid that situation, as banks can pledge treasury collateral at the Fed at par and do not have to sell their treasuries in order to raise capital.
So then what are you expecting in terms of contagion? Obviously, Europe has a different level of exposure as well, but also we saw Asian banking, Asian financials rattled as well when this first broke. So talk about the contagion here and how contained you think it might be.
There's certainly risks because you rightfully point out, this is not just an interest rate issue here, it's a global interest rate issue. Everywhere we dealt with the pandemic having an impact on inflation in a similar way, and everywhere central banks reacted in the same way by ratcheting up rates much faster than they've done over the last 20, 30 years. And this is the interest rate shock that we're now living through in this current crisis. It's coming to roost in order to, on banks' balance sheets that have to then, basically solve this issue by selling government securities. So, Japanese banks hold almost 500 billion of government securities on their balance sheet, same in Europe. So people are looking at that as another pressure point. And yes, that could cause contagion or these fears of it and people reacting. So I do expect here somewhat more tremors from here to go.
And so then for people who are trying to find a safe space for their investments at this time, especially since we don't know for sure what the Fed is going to do, perhaps a 25 basis point hike, obviously still a lot of movement here as it is a very data dependent Fed. Where do you see some of the safe havens that people could perhaps park their money at this time?
So we're seeing it playing out live, Rochelle. Like the 2-year yield has now fallen more than 125 basis points from the high of just last week. So it tells us that that's where really the money is moving, and that probably will be at the moment at least, the safety that you could seek. But you don't want to be all into just treasury bills and 2-year notes if this is still a situation where there is a financial stress. It will affect the economy. That's why interest rates are lower. But we're not in a Lehman type of situation just yet. Hopefully we don't get there, by the way. But I think, therefore, for investing, it's sort of a combination of, yes, you maintain liquidity and safety with treasuries and T-bills, but you also could look at opportunities in emerging markets, for example, or in Asia, or even in some of the really sound regional banks that are not in that kind of a situation that the SVB examples showed. So I think there's opportunity to invest there, but it's obviously a very uncertain environment. So being liquid and having treasuries in your portfolio is currently beneficial.